7 Mistakes Every Investor Makes. The pandemic has brought a new wave of investors into the market. Everyone still remember the excitement of putting the first dollar into investing, and most of us are eager to give the stock market a shot. While I would love to tell you that it will be a smooth sailing ride from here onwards, the reality is that investing in the stock market is more of a roller coaster ride. Still, it's always good to review common investing mistakes in order to avoid making them, and that's true for more experienced investors as well as newbies. Here are 7 common mistakes to avoid. 1. Thinking a low-priced stock is cheap. Many people see a stock priced at, say, $10 per share, and think it's cheaper, more of a bargain, than a stock priced at $50 or $200. That's far from true. A stock's price alone tells you very little unless the price is below about $5, in which case it's a penny stock and probably extra risky. You usually need to compare a stock's price to at least one other number to get much meaning out of it. For example, multiply the stock's price by the number of shares outstanding to arrive at its current market capitalization, or market value. Now imagine 2 stocks, each priced at $10. If the first has 1 billion shares outstanding, its market cap is $10 billion. If the second has 50 billion shares outstanding, its market cap is $500 billion, and it's a far bigger company. Comparing a stock's price to its earnings will give you its price-to-earnings (P/E) ratio, and comparing it to revenue gives you its price-to-sales ratio. These offer rough ideas of how overvalued or undervalued, or perfectly valued, the stock may be. 2. Following advice from social media blindly. When I first started investing, there wasn't a lot of financial education materials readily available, and I had to do a lot of my own research to understand about investments. Today, we have a lot of information on the internet, but I cringe at some of the information that is available for investors. We have an overload of information, and to make things worse, there is so much misinformation out there, especially on social media. Thanks to social media, we see a lot of stock market gurus showing off their latest Porsche car, or a video of their fancy vacation, and it portrays investing as something that could be done without much work. If you buy into that story, you are in for a disappointment. While investing is no rocket science, it requires in-depth research in order to make informed investment decisions. In general, do not take any stock tips blindly, because you need to weigh the options provided to you against what you may already have. For example, you may be better off putting that money into your employer-sponsored retirement account, or you might already have too much holdings on high-growth companies in your investment portfolio. It is good to exchange ideas on social media, but always do your own research. 3. Averaging down on a loser. Sometimes it is okay to make mistakes when investing, but it is always a bad idea to double your money on losers. At times, I know it is a dilemma, especially since the stock price is determined by various factors, and at times, even good companies would see a decline in their share prices. Personally, I do not focus too much on the share price but on the fundamentals of the company. This includes their financial performance, balance sheet, and even if there is a change in the management team. So, if you realize that there is a structural change in the business of the company that you have invested in, and it is not going to recover anytime soon, adding money into that uncertainty might just be throwing good money after bad. It is important to grow your wealth when it comes to investing, but it is even more important to preserve your wealth. Warren Buffett used to say this: rule number 1, never lose money. Rule number 2, never forget rule number 1. 4. Sell your investment too quickly. Be patient. Trust in your research and convictions, and wait it out for years or even decades while great companies you invest in grow. They won't always do so in a straightforward fashion, and there will likely be pullbacks. It can be hard to do, but stay the course. Of course, if your research and keeping up with a company causes you to lose confidence, consider selling. These are some common blunders made by new investors, and many seasoned investors make them, too. The more kinds of investing mistakes you learn about, the more of them you may be able to avoid making. Investing mistakes can be very costly. The more you know, the more money you may be able to make. 5. Borrow money to invest. There are people who would borrow money to invest because they have heard about the multifold returns that comes with leverage. If you are thinking of borrowing money to invest, don't. The stock market is volatile, and even if you have invested in a good company, it would take a while before the share price could go up. There is also the possibility that the market did not recognize the value of the company, resulting in share price decline and amplified losses for you. Imagine if you are borrowing money at a 4% interest rate, you would need to ensure that your portfolio's return exceeds 4% every year to achieve profits. So, if you are eager to have exposure in the stock market but have little capital to start with, consider other alternatives such as the exchange-traded funds, ETFs, or index funds that are available. 6. Falling in love with a company. Sometimes, it is easy to fall in love with a company, especially if the company that we invested in is doing well. This is one of the mistakes that I made early on, and while it was a painful experience, I am glad it is something that I learned when I was younger. At the end of the day, if the fundamentals of the company and its businesses change, consider selling the stock. Remember, you invest in the company because you believe in its sustainable growth. If this has changed, it is time to move on. You are not married to the company that you are invested in. Consider putting your loyalty into your marriage instead. 7. Failing to diversify. Here is an exercise that I would encourage investors to do, especially if you have been investing in the stock market for a while. Ask yourself if you know the exposure that you have in different major sectors. If you cannot answer this, it is likely that you have invested too much in certain sectors. Unlike professional investors who have different analysts to look into various sectors, individual investors like you and I have to monitor the entire portfolio on our own. There is a limitation to our ability to understand the business nature of different sectors, and I noticed that we tend to favor companies that we understand better. For example, if you are familiar with semiconductor stocks, there is a high chance that your portfolio consists mostly of these companies. The downside risk to this is you would be exposed to a systemic risk or an event that can trigger a severe instability of an entire industry. I remembered back in 2014 when the Brent crude oil collapsed from above $100 level to below $50 level, one of the portfolios of a fund that focuses on energy stocks saw a severe collapse in value. If professionals who do not diversify their holdings could suffer deep losses, it could happen to us as well. So, if you have already invested in the market, make a conscious effort to ensure your portfolio is diversified. As a general rule of thumb, try to limit exposure to 10%. Mistakes are part of investing, and these lessons are what makes us better investors. Having said that, I hope that by sharing with you some of these common mistakes, it will help you to succeed as an investor without going through all these painful lessons. Well, thank you so much for watching. If you enjoyed today's video, please give it a thumbs up and subscribe our channel for more content like this.